Top three things in my notebook this morning. Number one, the U.S. dollar. Number two, oil. And number three, the 10-year bond yield. First on the dollar, which is completely dislocated, by the way, from bond yields currently. But again, we do see the U.S. dollar manifesting into lower for longer expectations from the Federal Reserve. The dots have been pushed out. The June meeting looks highly unlikely that they're going to become hawkish there. So again, dollar down and breaking down. And this is not new, by the way. The dollar obviously has been weak for the last month. You've had a 3% correction in the dollar, and I would characterize it that way. But again, a correction can create plenty of confusion in as much as it can create some reflation in point number two this morning, which is oil. And oil really continues higher as the dollar continues lower. Most people who do the whole supply and demand thing are starting to talk about oil demand being better. I mean, oil demand, just newsflash, was better the whole while. People did have demand while we had lower gas prices. There was plenty of demand there. The reality is that the oil price is trading with a 0.87 immediate-term correlation to oil. And again, get the dollar right, then you get oil right. So again, dollar down this morning equals oil higher, up 1.2%. Not yet tapping the top end of the risk range, which is 62.36 on WTI. And what I'd say are 2 points on both the dollar and oil. Both the euro versus the dollar and oil itself, WTI, are now making a series of higher lows pretty consistently now within a narrower risk range. So again, we can talk to you offline about what that means, but again, a narrowing risk range is pretty bullish for both the euro and oil relative to dollars ahead of the catalysts, which are, of course, U.S. GDP revisions on May 29th, jobs report on June 5th, and Federal Reserve meeting on June the 17th. 10-year bond yield in the face of all that has been going complete squirrel. Yes, the word squirrel does matter. You cannot find that in a Yale economic textbook, but that is what I call things when they go completely berserk. So again, 10-year bond yield, that's exactly what's happened. I mean, you could have looked at it right around this time yesterday, and I think it was like 13 or 14 basis points higher. I mean, and then it's 13 or 14 basis points lower. I mean, these are huge moves, unprecedented moves in the U.S. 10-year bond yield, in as much as we've never seen moves on a percentage basis like this in European bond yields. And most people would say, well, you know, we're bond guys. We don't talk in percentage terms. Well, guess what? Risk models work in percentage terms. So the reality is that we've had huge volatility. And again, we've not been able to, and this is the point, we've not been able to get above 2.39%, which is the intermediate term trend line of resistance at Hedgeye on the 10-year bond yield. So again, we remain bullish on bonds, even though it's been painful for a month, but it's been relatively gratifying for the last 16 months. If you take out a month, but I can't take out a month because 1 month may change my career. And those are your top three things.